money printing is not going to solve the problem, and it's not going to prop the markets up until the end of the world, so to speak. It's just, there's some point where you reach an equilibrium where no matter what you do, the natural business cycle needs to play itself out. And right now, we're in the longest recovery as far as, judging from the most recent recession up until now. And the stock market is way up there, and it's been running at all-time highs, blue sky, for the past 3 months. We've been in blue skies, not just recently. And now that we got the coronavirus, I wouldn't be so excited about the markets right now. And it would be prudent to have a plan.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. We are committed to being your trusted source for low-cost, highest-quality investment-grade bullion products. Visit SDBullion.com for more information.
Welcome to this Silver Doctors exclusive. Today I'm excited to have first-time guest, Ms. TraderStef. She's an author, investor, as well as a trader. And today she's joining us to share her thoughts on the global economy, our current monetary system, and where she thinks things may be heading. So TraderStef, welcome to Silver Doctors.
Hey, Mike, how are you?
I am doing excellent and excited to have you join me today on this episode here. Definitely looking forward to getting your thoughts on a variety of subject matter. And so I follow your blog, and we've talked before. So definitely you do a great job of educating the public. So I'm looking forward to getting your thoughts on a variety of subject matter. So
awesome.
Before we dive further, for those that may not know TraderStef, can you give us a little bit of your background and how you've currently arrived at this point in your career?
Sure. Worked in the New York City financial industry for a very long time, and ended up in global risk management at Citigroup, particularly as we were entering the great financial crisis. And during that time, the folks who I was working with and working for, we decided to go our separate ways. Some folks went to Washington, some folks went to other states, and I decided to make the move. And that's where I ended up being involved in a live trading room. And I was mentored by one of the greatest scalpers, at least in trading, as far as trading is concerned, that I ever met. And he trained me, and I developed my own webinar, which was called The Precious Hour. And it's based on fusion analysis. And, when people see my name, TraderStef, they tend to focus on the word trader, right? But it's a lot more than that, because fusion analysis is taking the study of fundamentals and what's going on in the world in general, and also applying technical analysis to the analyses. And at some point you come to some kind of idea of, where we might be going. And my focus tends to be the precious metals, gold and silver, but I also touch on mining stocks now and then, and the stock markets, and, perhaps an equity that may be showing some promise here and there.
Okay, sounds good. So I appreciate you for sharing that. And so let's dive right into it. And so we're currently experiencing a lot of things. It looks like we got, we have a virus that's going around. We got the Iran situation. We have impeachment. So we have a variety of things that we can probably touch on. But I'm curious to find out at this current moment, what are you keeping an eye on? What concerns you the most out of everything that's currently underway?
Definitely SARS 2.0.
All right, break it down for us.
It's the biggest problem. It's a major threat to the global economy. And there's a lot of information that was not made available to the general public because, one, it wasn't known. And two, the mainstream media there's a lag time, and they don't want to cause panic. But the primary reason why this thing really didn't hit the mainstream media in the degree that it has is there were a lot of specifics about this particular strain that was not available. And there's a great virologist out there, and there's a big difference between a virologist and an epidemiologist. And, the joke or the truth among virologists are they're the guys that are sitting at the end of the table at the emergency meeting who are waiting for everyone else and all the epidemiologists to catch up with them. And Dr. Henry Nyman, PhD, has been a virologist for 45 years. And he was the guy that discovered the mutation and the original SARS outbreak back in 2002, 2003. And he picked up the phone and called the guy in China at that time, and they ended up corroborating on a white paper and making the information known that eventually became the fact that it came from a bat, and there was a mutation. But they had caught it in time. And with this particular virus, it has now become known that the first case was actually on December 1st. And Dr. Nyman had got a hold of the genome that they finally found, or did the work on it and figured out what was going on. And he noticed the same mutation within this particular strain. Out of 40,000 coronaviruses that are in the database, it matched the one from 2002 through 2003. So, he's the guy, and he knows what he's talking about. And he broke this information over a week ago in alternative media. And there's a lot of issues with it because the initial testing that was being done, they were using the old test kit. But this particular strain is actually a mutation from that strain. And they didn't develop the new test kit until like late in December or early January. So they were going back in history playing catch up to retest all the original cases that they had or didn't realize that they had because they thought it was the flu or some other virus that was going on. They really weren't sure. And then they realized that, they put two and two together and they realized there was a problem. But by that time, in the city of Wuhan, China, which I sent you a map that shows a visual of China, and Wuhan is, think of it as New York City. New York City is a main transportation hub. Everything kind of bleeds into New York and then it leaves New York, whether it be trains, airports, roads. Wuhan is the same, but Wuhan has a larger population base than New York City. So, and we were going into the Lunar New Year, and they travel quite a bit. And the 55 million or so trips that folks make for Thanksgiving, for instance, in the United States, what happens during the Lunar New Year in China just dwarfs that number. So there were people that were leaving Wuhan that were infected, didn't know it. And at this point, we found out that the incubation rate can be anywhere from 7 up to 20 days. And you can be contagious without exhibiting any symptoms, which is what happened to this guy. I think it was the first case in Seattle, and he was in Wuhan, and he took 2 different flights to get to Seattle and drove 30 miles to his home. And then within a couple of days, he heard on the news that there was an issue in Wuhan and he wasn't feeling too well. And then he went to the hospital. So there are now these clusters that are beginning to pop up. And with the appropriate test kit, that takes a while to be distributed and created across the globe, we're beginning to realize that this is a much bigger problem than it was. So China is basically in lockdown at this point. I think as of last night, they not only have the quarantine or partial quarantines of some of the major cities and we can call them counties like we have in the United States, or even states for that matter, are completely closed down or partial travel restrictions. But China wants to stop all travel out of China at this point. And the US State Department has issued a level 3 restriction that we're not telling you can't go to China, but we really don't think you should. So this thing is a developing story. The numbers are going to go exponential at this point because of the various reasons that I mentioned. There is a lag time involved. And there are some numbers being floated around about mortality rates. And they're giving out single digits, but that's actually not how it's done. People are taking the number of deaths that are quote unquote officially reported and comparing it to the confirmed cases that are out there. and getting this percentage of 3-4% mortality rate. That's not what you do. You actually take the number of deaths and you compare it to the number of resolved cases. Now, why that's very important is that are people who were already confirmed as being infected, were in the hospital, recovered, or are still in the hospital, maybe in critical condition, and or were released. So once you're released or you die, that is a resolved case. And when you take that number, where we stand right now is over 100% mortality rate. Now, with the lag time involved in the issues discussed, it's going to take several weeks for this number to find a median. But at this point, we do know two things. It's more virulent than the SARS in 2002, 2003. And the cases are going to explode. And it's already at a much higher rate than the initial SARS outbreak was in 2002, 2003. So consider China, transportation, industrial base, lockdown. It's going to affect the rest of the world. And even if this thing begins to resolve itself within a reasonable amount of time and it doesn't really get bad, like the movie Contagion, I think that was from 2011, that is an excellent example of what can happen and how it started. And they even referenced the bat virus because it was based on SARS.
Yeah, let me ask you a question. And so in describing this whole development of the Wuhan coronavirus, and so the mutation aspect, do you think it was a natural mutation, or was this some type of scientific lab mutation that was released, or so it's a strand of an older virus, so was it a natural mutation, or was this something that was probably strategically done or man-made or man-altered again, or what are your thoughts on that one?
Yeah, I've seen a lot of rumors floating around the internet, and they could be relevant, because there is a biowarfare lab basically in Wuhan, by the way, and there could have been a leak, or it was done purposely. I mean, who knows? But the fact is, the first case they have finally identified occurred on December 1st. Now, that person actually didn't have any physical contact with the wet market, is what they call them. They call them wet markets because, everything's wet. And you got all these wild animal meat and all these things, these exquisite cuisines that they enjoy over there. And you're very susceptible to getting infections. But this person never went to that market. So that begs the question, how was this person infected? Well, hey, they could have made bat soup like a regular thing for themselves more often than you would probably want to do yourself. And maybe they just happen to pass the virus on to someone else that they know who just happened to went to that particular wet market, and that's where it was transmitted to a vendor who happened to be selling bats. So there's a lot of possibilities here, but I wouldn't necessarily jump to the conclusion that this is some kind of population control conspiracy at this point.
Mm-hmm.
It's not saying that it's not, but we really need to be careful about what we're putting out there. And I think the focus on mitigation and your own protection and being aware is much more important than worrying about who or where it came from right now, because we do know where it came from because it matches that particular strain from 2002, 2003.
Yeah. All right. So the impact it will have on the economy. So you hinted at China, basically, if they go on lockdown, I mean, all industries will have to come to a halt as well. Therefore, there will be a lot of activity or lack of activity. And so how will that play on their economy? And then how will that probably even trickle out? So we got the health issues, then we're going to have the economic issues and concerns. Give us some of the rundown as to how China slowing down can impact the rest of the world.
Well, on that thought, there was an article that was published by Forbes last night. And the title of that article is a black swan event that may have serious repercussions for the U.S. economy and job market. How bad could it get? The article was realistic. It left out of information for the sake of being succinct and not too long and lose your attention span. But there's no telling what the impact could be. I mean, if you just go through the scenario in your own head with regard to how this is spreading so fast, it could be a worst case scenario, or it could peter out and we're safe. But no matter, it's going to be, there'll be a lag time involved with how it will affect the global economy. And we don't know how long that's going to be. There will be an impact. The Fed is meeting today in their monthly FOMC meeting. And there's a possibility that they may want to up the ante beyond repo and do a preemptive action to try and blunt the initial impact that this may have on the global economy. So we'll know that tomorrow once they make their monetary policy announcement. So we'll see what happens.
Now, what type of preemptive toolkit measurement would you see them possibly considering?
I don't think they would up the repo operations, which actually the official numbers is about 6 trillion in loans. You know, the majority of them have already rolled over because of their repo. But maybe they'll lower the interest rate a quarter point. Maybe they'll raise the interest rate on bank reserves that the large commercial banks are holding at the Fed. I don't know what it's going to be. It's a crapshoot, but we'll find out tomorrow for sure.
Interesting. And so as it appears that the Chinese economy might slow down, then therefore all the goods that will not be leaving there will not be delivered to other economies that's dependent upon them. So there will be some clear repercussions for that. So yeah. I'm curious. Okay, I'm sorry. You want to share your thoughts on that one?
Oh, yeah. It's already slowing down.
At a time that the economy is supposed to be already slow, but yet our economy is expanding and doing good. So which one is it, you think?
It's not a matter of if, it's when we're going to feel it. There will be repercussions. We just don't know what the severity will be. And that can't be determined until we know how far this virus goes and how bad it gets. But right now, it's pointless to discuss, well, what state has it got into and what country it has gotten into, because every day the numbers are doubling and a couple more countries are getting cases and a couple more states got cases. So cat's out of the bag, basically. Mm-hmm. It's hard to make a determination at this point because it's an evolving situation.
All right. So we have a health crisis in a sense, where this whole virus, which can get out of hand, which will hopefully, I'm praying that it doesn't get out of hand and there's some type of, easing of this, resolution of this, or something, solving of this before it becomes beyond too serious. But we also have a economic crisis as well with the repo market. So I want to touch on that a little bit because you mentioned 6 trillion.
Okay.
And is there any end in sight, or will this be an ongoing continuation of what is needed to keep the narrative of a great economy going?
Well, with regards to the FOMC meeting, there may be some important details that will be found that they're either announce or won't announce, and you won't see it until the minutes come out in a couple of weeks. That being, I don't recall his name, which Fed Reserve president it was, at one of their 12 branches. But they want to keep the repo market open-ended. Now, remember when it first started back in mid-September, it was, well, they wanted to do a little bit of repo up until maybe the end of the year. And then they were like, well, we're going to extend it into 2020 for a few months. And then, well, it looks like it's going to be June. Now they're talking about making it a permanent open-end operation. And their specific concern is exposure that some hedge funds have with regards to liquidity in the overnight lending markets. Now that could morph into a completely different liquidity shortage scenario due to the virus outbreak. We don't know what effect that's going to have yet. But so they're already talking making repo permanent. And the 6 trillion is the total number that they've rolled over. But they're pumping out every day or two, they're pumping out 60 billion, 100 billion there, 60 billion there. The numbers are getting high, and remember their balance sheet topped over 4.5 trillion subsequent to the financial crisis, and they tried to pull that back. I called that the taper caper. And they really tried, and they tried to get interest rates up to at least beyond 3% or up to 5%, because you need some leeway in a downturn to be able to blunt any problems by lowering interest rates first, because that's their first and most effective tool in their toolbox. They couldn't even get that far. So they stopped trying to do quantitative tightening, which that was, and they started lowering interest rates and started repo. So they don't have much room. And one other thing is, yesterday, the bond market really took a hit along with the stock market. And interest rates, there's two different kinds of interest rates you have to consider. Number one, basically Europe and most other countries, when you look at their bond market, or we could say treasuries, there's an interest rate that treasuries are offering. Forget about the inverted yield curve stuff, but just the rate that the actual bond's offering. So yesterday, the 10-year plummeted down to 1.6. Now, the current rate of inflation is, depending on which formula that you look at, it's somewhere between 1.5 and 2.3. Let's take the average 1.8. So if you take that 1.8% inflation and you subtract it from the interest rate on, let's say, the 10-year bond, which is now at 1.6, you're in NERP land, which is negative interest rates in the Western world. And that is one of the things that kept the stock market and the dollar floated, because it was the best kid on the block. That's where a lot of money and assets were flowing. Now that we're kind of playing around with NERP here in the States, real NERP, that may be the beginning of the end of the party to some degree, but it will take some time to play out. If this continues and those 10-year rates and the shorter term rates below that remain in negative interest rate territory.
Now, oh wow. So as the Federal Reserve continues to juice the markets to provide liquidity to keep this narrative going of a great economy, you're anticipating, or should we anticipate an ever increasing inflation of the already overinflated asset bubbles when it comes to equity markets, house prices, and other areas that's been artificially propped up since the last Great Recession? And so will we see, 30, 40, 50,000 down because of all this juice, or what? What are your thoughts?
Well, the argument is, well, you got the PAL put. There's the Greenspan put and the Bernanke put and the Yellen put. Now we got the PAL put. And that leads to complacency. It's a moral hazard, as they called it, when you get into the irrational exuberance realm, as Greenspan coined the term. Money printing is not going to solve the problem, and it's not going to prop the markets up until the end of the world, so to speak. It's just, there's some point where you reach an equilibrium where no matter what you do, the natural business cycle needs to play itself out. And right now, we're in the longest recovery as far as, judging from the most recent recession up until now. And the stock market is way up there, and it's been running at all-time highs, blue sky, for the past 3 months. We've been in blue skies, not just recently. And now that we got the coronavirus, I wouldn't be so excited about the markets right now. And it would be prudent to have a plan. And that plan would be to be able to move some of your investments into cash, despite the fact that, as Ray Dalio mentioned over in Davos, he's like, cash is trash, buy gold. You just really need to mitigate the risk and be able to move some of sell what you can that is going to take a hit, move it into cash and wait for this to play out. And then you can reinvest when we hit some kind of bottom. But the volatility in the market that the market's experiencing right now is really for a professional trader that understands risk management and are glued to their screens. This is not the kind of market for average Joe to go FOMO, fear of missing out and just jump in and keep throwing money into your 401k because your company's matching your donations. Now, we're in a different world.
Now, what about your long-term investor, someone who's, say, just passively, they're focusing primarily on their career pathway now and just, having everything automated into their retirement portfolios and the funds and all types of things that are been offered product-wise, and they're having the mindset of 10, 20, 30 years retirement-wise. How will the markets, in your opinion, once this correction takes place, impact those people that are just passively saving with the concept of compound interest out throughout time, everything that they've been told by their financial advisor?
Yeah, that really depends on the severity of any correction. And, the coronavirus right now, it's a black swan, quite frankly, and we don't know what the effect's going to be. So I can't really op-ed on the potential effect. But if I can mention, remember, if anyone out there had investments in a 401k or IRA or anything, let's say just prior to the great financial crisis, and then when things started to go down, there's a certain psychology that takes place. And if you were a passive investor, for instance, and you would get your statement at the end of the month, it took a hit and it really wasn't too bad, and you're still within the mindset that, well, it always goes up. Okay, eventually if you hold, it's always going to go back up. And then when you really start taking a hit, then the psychology flips to, well, crap, I've already taken a hit this bad, I might as well just wait it out, right? And then they start ignoring the statements. They don't even want to look at them when they come in the mail. Right. Keep in mind that when you look at whether it be the Dow or the S&P, if you look back to the 1999 dot-com bubble in a chart, it's a total of 13 years before that high was retaken out, or was actually taken out. Didn't happen until 2013. So you were sitting at those potential lower lows, choppy market for 13 years, and throwing money at your account. Now, if you held, okay, well, that psychology apparently worked for you out of dumb luck. But the dumb luck was QE. That's what rocketed the market. Yeah. So when that 13-year lateral high was taken out on those charts, gold just happened to be in a correction off the 2011 high. And you can do the vertical line on the chart. As soon as it took out that high in the stock market, that's when gold took a hit, because money realized, hey, the Fed's got our back. We're at new highs after 13 years. That took a long time. We're going higher. Money rushed into the stock markets. So right now, being that we're at all new time highs, like I said earlier, it's not the time to be FOMO. The time now is to be cautious, no matter what the Fed does, because we don't know what's going to happen. And I think a major point that many people are missing, and I don't want to get too deep into this topic because we'll be here all day, but automated trading. And I'm going to quote Jim Rickards because, he kind of verified that for me on December 6th. And he said, today over 95% of the New York Stock Exchange trades are generated by robots using algorithms to decide when to buy and sell. Trading is no longer a man versus man or a woman versus woman. It's robot versus robot. Now, the good news is that robots are easy to figure out. They automatically based on source code and algorithms on mathematics. And the robos buy and sell based on headlines or keywords. So that's where technical analysis comes into play here. Why it's so much more important than, say, it was even 10 years ago. Because so much of the trading is being done by mindless machines that is primarily based on technicals and news headlines. But a lot of folks might argue this point, but technicals happen before the fundamentals are known. So charts are almost like have a predictive quality. And when you do the percentage as far as accuracy, it's about 70% accurate. because there's nothing that's 100% accurate. If that was the case, we'd all retire already, right? But you can't. So, 70% success rate for technical analysis. It's a tool you have to have in your toolbox, and that brings home fusion analysis because you're looking at both sides of the equation.
So as we draw towards the end, I definitely want to get your thoughts on precious metals, gold and silver, assuming that all the risk you've laid out for us with the virus situation, with the juicing of the markets by the Federal Reserve and everything else, gold and silver. I assume that that's something that people should really begin taking more of an interest in, perhaps, or what are your thoughts?
Which one you want to talk about first?
Wherever you like to take it.
All right, let's touch on silver. Silver is gold's little brother, right? And your audience is a very smart audience, I'm sure. So I don't need to get into the basics of gold and silver and why it's money. So let's just talk price points and some charts and where we're at right now. If you pull up a weekly chart of silver back to 2000, you'll notice that these things I use are called Fibonacci's. Fibonacci's are the math of the universe. Look it up. And no matter where you apply it, it works. And you can snap Fibonacci lines on a chart. And then as you see that history play out, it confirms for you that they're actually very relevant. So you can use them by snapping those lines and extend them out into the future, and then you know where your resistance and support levels, major ones, will be, aside from things like trend lines or moving averages or lateral and resistance and support. So if you look at that silver weekly chart going back 20 years, there was a high that we put in back in right around 2008, and it was a Fibonacci level, and it was basically 2150. The exact number is 2149. Now we hit that high in 2008. Then in 2008 we had the crisis. There were a lot of margin calls. One of the things major institutions and some traders go to immediately when they need cash, they'll sell some gold and silver, and that's why we had a fall in gold and silver during the great financial crisis, which then they actually outperformed the stock markets as far as when all was said and done, gold and silver actually gained. So if we look at that 2149 number, the stock market crashed, and then it bounced, and the moment that it took out that 2150 again, that's when silver had its major run up to its high in April of 2011. And then it plummeted. And when it did that, when it went down so fast, the first bounce that the stock had, or silver had, I should say, hit that Fibonacci line and bounced around. And then it continued further until it hit its low, down around 13 bucks an ounce. So that's 3 taps on that line. Now, when we got the run in 2015, where we hit the low, which we can say that's the beginning of the bull market, the restart of the bull market in both gold and silver, that is the same level that we got to. On silver, it was 2113. It just didn't have what it needed to get further and up through that Fibonacci level. Then we corrected, and then we fell back to not the same low. It was slightly higher, but in late 2018, early 2019, we bounced, and ever since we've been doing pretty good. And as of this moment, I'm looking at my charts, we're at 1751 on the silver spot price. So here's the thing. Silver is extremely undervalued. I think accumulating physical, and if you're in the paper realm, accumulating core positions, there's really nothing wrong with that. The fundamentals definitely stand here, but you're not really going to see any rocket shots until that 2150 is taken out with conviction. That's my call. I've been making it for at least 3 years, and I'm sticking with it. If we want to get on to gold, not the same story. It's a very different story. And if we look at the weekly chart, which I actually just published last night, because the coronavirus is a big thing, and there are safe haven flows right now in the markets. People are very concerned. Institutions are executing risk management. That's what you do. But looking at that weekly, if we look at the middle of 2018, where we put in our last low, we have a really nice up channel. So we have a solid uptrend. we took out an extremely important Fibonacci level, which was 1380, which goes all the way back to 2013, by the way. We took that out. We had a nice spike. It went into a falling wedge, and you'll see this on the chart. And then right around Christmas, just before Christmas, I said, expect, a nice run. It's coming up very shortly. And it was the next day it took place. We busted out of that pattern, and we ended up putting a high in early January because of the Iran geopolitical situation. At that point, it got a little bit overbought. And, people tend to focus on the intraday wiggles. And the other thing I find interesting is that people complain about manipulation, which is primarily high frequency trading and spoofing and that kind of nonsense by the computers and the gamblers. It's not government sanctioned stuff going on here. Yeah, that was more relevant 10, 15, 20 years ago, but not now. But it was overbought, and it's got to take a breather. And what we're seeing right now is every time we get a spike in the price on shorter term charts, the machines are very efficient at scalping profits. And then you get these breathers. And then a news event, or it just plays itself out, and then we pop a little bit higher. So we've been consistently putting in, we're looking at the weekly chart now, higher highs and higher lows in a well-defined up channel. And the studies below that, you'll be able to see that, how it's playing out. But most recently, there was an issue with volume. And volume is very important, folks, because think of it this way. If the price is going up, you want to have the volume on that price rise to be trending higher as well. If the volume is trending lower on a price rise, that tells you that rise is probably kind of weak, and it's going to be approaching its end pretty soon, and there's going to be need for a correction and consolidation. So we've actually just entered a period where we're starting to pick up on the volume after we broke out of that falling wedge pattern right after Christmas. So right now, anything could happen. The Iran situation is very volatile because their proxies and the militia are still shooting rockets at the green zone in Iraq, and actually they hit the embassy, U.S. embassy yesterday, and hit the dining area. And I think some folks were injured. As far as I know right now, no one's got killed. So there could be one headline that comes out and boom, you get a spike. There could be another announcement with regards to the coronavirus. Boom, there'll be a spike. So we're in a point right now where risk management is very important and safe haven assets are very important. And, gold and silver is the go-to asset in so many ways, and just too many ways that I can expound on, but we don't have the time.
Yeah. Well, that was a very interesting layout of the problems and solutions, or some strategies. So, TraderStef, it's been great having you join us here on Silver Doctors. For those that may not be familiar where to connect with you at, can you point them back in your direction so that they can stay in tune with what you have going on?
Oh, absolutely. I publish an exclusive over at crushthestreet.com, my articles. And then several days later, it gets posted up on my website. And that is TraderStef, and that's spelled with an F on the end. So TraderStef.wordpress.com. And definitely follow me on Twitter. And my handle is TraderStef.
Sounds good. Well, TraderStef, it's been great having you join us here. Looking forward to staying in touch with you, and definitely have you back on in the days ahead as things unfold and we have more a clearer understanding as to what's really going on, and then getting your thoughts and analysis then. So once again, thanks for joining us on Silver Doctors.
Hey, can I give you one more plug?
Yeah, go ahead.
Yeah, I'm sorry. I'm starting a technical analysis 101 training. If anyone's interested, go to my website. And I'm a little delayed here in getting it launched. I expected it to happen, in late January, but due to the coronavirus and what's going on right now, I've been a little preoccupied. I'll be launching in early February. So send me a note there on the website and let me know that you may be interested in some training.
Sounds good. Well, once again, TraderStef, thanks for joining us. Looking forward to connecting with you again. Thank you.
Thanks, Mike. Have a good day.
You too.